First thing I wanted to do, because many of you are familiar with certificates of deposit and many have extensive or sometimes only investments in CDs, I wanted to just review what's involved with those investments and review them as investment vehicles. So when you go to the bank and take out a CD, you recognize that you are loaning money to your bank. You're giving them the money and they're giving you a promise to pay. They're going to pay you a specified rate, and they're going to do that for a specific term. So I'd like to say you're going to get 1%. That might be hard to do even today, but 1% for 2 years or something like that. And you know you're going to get the interest, and then you know you're going to get your money back at the end, but it's a loan to the bank. You recognize that there's a penalty for early withdrawal, so your money's pretty much tied up there in the bank. And if you want to get it out early, you can, but you're going to pay a penalty to do that. Importantly, we have FDIC insurance to secure the bank's obligation to repay you. And that all came about after the Depression because people were concerned about banks repaying at that particular time, and so we've got FDIC insurance. Now, we all recognize that the FDIC insurance has limits. It's $250,000 per depositor. Just a reminder, we wrote about this in our insurance newsletter here recently, but it used to be unlimited FDIC insurance for non-interest-bearing deposits, but that was removed, and the $250,000 limit now does apply to all types of deposits, including non-interest-bearing deposits. So if your organization is in a situation where you are traditionally maintaining bank balances in excess of that amount, you may want to consider either opening a deposit account with a different bank, or you can consider using what's called a repo agreement, where the bank actually pledges securities out of its investment portfolio to you as collateral for the amounts in excess of the FDIC insurance limit. This is a very safe way. In fact, I would submit it's perhaps even a little bit safer than the FDIC insured amounts. Unfortunately, there may be some variability in how the commissioner looks at these repo agreements. I've heard some say that the commissioners told them that they're perfectly fine with it. I've had other cases where we've heard that the commissioner views that as a type 2 investment because it's in excess of the FDIC insurance limit. So just be mindful of that if you get into that situation. But that is our situation with CDs. Now, the question is, you loan your money to the bank, and we've been focusing on what their relationship is with you, but then the question is, what does the bank do with your money once you give it to them, once you loan it to them? Well, what they're going to try to do is go out and invest it in something that's going to earn a higher rate of interest so they can pay their costs and all that kind of thing, and still have enough left over to pay you what they were obligated to pay you. They do a couple things. One is they lend money to businesses and individuals and so on and so forth, but they also have a significant part of what they do with that money is tied up in investing in bonds, investment-grade bonds of the type that we're going to discuss here today. So the point is that if you invest in CDs, you basically are hiring the bank as a middle person to be in between you and investing in bonds. You may benefit from considering getting rid of the middle person and going investing yourself directly in the same kinds of investments that the bank would use. And so that's what we're going to explore here today. Bonds are basically of the same type of structure as a certificate of deposit. They're a loan to the issuer. They have a fixed term and a specified rate. So you might invest for 2 years at 1% interest, just like you have with a CD. Unlike a CD, the repayment obligation may or may not be insured. There is no FDIC to insure these kinds of things, but there are private insurance companies that do offer insurance. Some bonds are insured, some bonds are not, so but there is that possibility. Issuers of these bonds would be the U.S. government. When they talk about the federal debt, that's what we're talking about, is these bonds that have been issued to the marketplace. State and local governments can issue bonds. So the state of Wisconsin, your cities can issue these bonds, in school districts. Many of those issues are federally tax exempt. Some are even double exempt, so you don't have to pay tax on the interest that you earn there. And then there's corporations. So the corporations will issue these debt instruments to the market. GE, Morgan Stanley, Goldman Sachs, Hewlett Packard, so all over the board. But so the issuers can be the government, U.S. government, state and local governments, or corporations. What we're going to focus on here today as an example that we can continue to refer to as we go through this is a GE bond. So let's say that General Electric comes out and they need to borrow $15 million. So they come to market with a $15 million bond issue. And the terms of it are that they're going to offer a 2% interest rate on the bonds. And that bond is going to be a 4-year bond. So it's going to be issued today and it's going to come due in 3 years, February 28th of 2016. And let's say that you're going to buy $100,000 of this $15 million bond issue. Just wanted to review a few facts about this particular purchase on your part, aspects to consider. Number one, when you go in to buy this bond and you're getting a $100,000 bond and you're paying $100,000 for it, it's common to think that there's no compensation. You're getting it from a broker, but there's no compensation involved. Well, that isn't really how that works at all. Just to give you a little insight into that transaction, what happens is an investment banker or a brokerage firm will go to GE and they'll either have a separate contract where they get paid a very large sum of money to distribute this bond, or sometimes what happens is they'll go and they'll say, look, we'll buy up this entire $15 million bond issue for $14.5 million. And then they go out and they sell it for $15 million, and then the difference between that is what their compensation is. So when you get these calls from brokers saying, yeah, I got this bond today, and we're selling it at par, which is $100,000, you immediately can think about the fact that, well, their mother organization has probably bought a big group of this bond, and they're incenting their brokers to get out there on the street and get it sold. So that's how that kind of a transaction works. When you buy this bond for $100,000 and you buy it today, it's going to pay, typically it's going to pay interest 2 times a year, every 6 months. So you get an interest payment on February 28th, and you get an interest payment on August 28th. So if you buy it today, typically the first payment will come on August 28th, and then every 6 months thereafter until maturity. And then, of course, at maturity, you're going to get your money back, assuming that GE doesn't default on its obligation. So you get $1,000 every 6 months, and then $100,000 back at maturity. One of the issues with this is what I just said. So are you going to be repaid? And what assurances are there in that regard? Now, as I said, some of these are insured. Some of them are not. Many of them actually are not. And so that's where the rating agencies come into play. It's their job to go out and assess the repayment risk associated with these different issuers. And there's 3 primary ones, Standard & Poor's, Moody's, and Fitch. The Commissioner's Office is more focused on the S&P ratings and the Moody's ratings. But that's their job, is to go out and assess the risk of repayment. As I said, some of these bonds may be insured, and if they are insured, of course, that's going to increase the rating. Many of the there's very few AAA issuers out there anymore. So many of the bonds that come out that are AAA rated, it's usually they're AAA because they have some sort of insurance backing them. And you need to be mindful of the fact that just because a bond comes out with a rating at the beginning, it doesn't mean it's going to stay that way throughout. Many of us remember when the U.S. had its credit rating downgraded here, I think it was in August of 11, so about a year and a half ago. That's an example of this point right here. Ratings do change between the time that the bond is issued and maturity, so it's something that a bond investor needs to be mindful of. And also understand that the rating is very important to the issuer, because we'll touch on this a little bit later, but the higher the rating, the lower the interest the issuer is going to have to pay to get people interested in purchasing the bond. And the lower the rating, the higher the interest the issuer is going to have to pay. So it's really in the issuer's best interest to try to get this rating as high as possible so that they can pay the least amount of interest. As far as the bond ratings go, here is a ratings chart that shows how these bond ratings work and what are considered to be investment grade bonds. These are bonds that banks can invest in. These are bonds that you are able to invest in as a town mutual insurer and still have them classified as type 1, would be bonds from this line and going up. So you see we've got the prime, high grade, upper medium grade, and lower medium grade, and those are all considered to be investment grade bonds. You see here for S&P, ratings start at AAA, go all the way down to A minus, and then we get into the triple B plus, triple B, and then triple B minus. Triple B minus being the lowest rating from S&P that you would be able to buy as a town mutual insurer. And then over here we have the Moody's scale for rating these as well. So a Baa3 by Moody's should be very similar to a triple B minus by S&P. Now, as far as the OCI rules about bond investments, which many of the insurers have bond investments that are categorized as type 1 investments, but there are some rules that you must follow in order to have them categorized as type 1 investments. The Commissioner's rules say you must have a triple B or better rating from S&P or Moody's at the time of purchase. I always find that to be kind of an interesting rule, because when you go back here, Moody's doesn't have a triple B aspect to their rating, so I'm not really sure what that means. The other interesting thing about this is it says at the time of purchase. So presumably, if you have a triple B bond at the time of purchase or better, it's always going to be a type 1 investment regardless of what, if the bond's rating gets downgraded to below triple B. That certainly would be arguable under the way they have this written. It's our position that if it's below triple B, it's no longer investment grade. We treat it for the purpose of assessing the portfolio compliance of our clients. We treat it as a type 2 non-compliant investment because we think they should maintain triple B throughout. And you also have to have a final maturity of 15 years or less to be a type 1 investment. So you can have an A-rated issuer, but if that bond doesn't come due until 2033, final maturity of more than 15 years, it's not going to qualify as a type 1 investment. Some of your bonds could be type 2 investments. Like the case I just gave you, where you have an A-rated issue, but it comes due in 2033, that would be a type 2 investment because it's otherwise eligible as an investment, but the final maturity is out beyond 15 years. And then we also have unrated bonds of a Wisconsin municipality that would be a type 2 bond investment. So here these don't have to be rated at all, and they'll be categorized as a type 2 investment, but the catch is they've got to be a Wisconsin municipality. Now, we've seen some cases where there are corporate bonds that aren't rated and that the insurers have been sold by brokerage firms. Well, those are not even really qualifying investments. We've seen issues where, in one case, for example, a California bond was not rated. And yes, it was a municipal bond, but it wasn't a Wisconsin municipal bond, so it too was not a qualifying investment. So you can have some bonds that are not type 1, but there's some pretty significant limitations on those.